Hello people, a very good day to all of you. So guys, we started with a new topic in the last class, which is goods sent on return and approval basis. So guys, we understood that there are certain business models wherein the business has to give an opportunity to the customer to return the product if they don't like. So this happens normally if you see in the e-commerce platform, right? Where the goods are sold online. So there the option has to be given, to the customers to return the goods if they don't like, or if the goods does not meet their specification. So apart from this, there are other business, as I said, example in the last class, the jewelry business, where the manufacturers, they go and give the manufactured, new product with new design. They go and give it to the wholesaler or the retailer. They keep it in their shop for, let's suppose, 15 days or 30 days. So within that period, if it is sold, then it is treated as a sale transaction. If not, they will take the goods and come back again, right? And we also understood very clearly the difference between the normal sale transaction, the consignment sale transaction, and also this concept, which is goods sent on return or approval basis. So we did a comparison as well. Under this particular chapter, guys, we said that you will come across 3 different cases, and accordingly, the accounting entries, the preparation of the accounting statements will also vary. The first case being a business which has got very limited transactions pertaining to goods sent on approval or return basis. So I told that normally these kind of businesses have 90% of the transactions happening in form of a normal sale transaction. Hardly 10% of the transaction will happen on sale of goods on return or approval basis, right? This 10% or 90% is not fixed. Here we are trying to indicate that very minimum transaction is pertaining to goods sent on return approval basis. Rest all majority is what? Normal sale transaction. So in the question, if they give you a hint that the transactions are happening casually, in that case, this particular transaction type will be treated as a normal sale. And we saw how to do the transaction, that is journal entries, in the previous class. And today also, guys, the questions that we'll be dealing with will be based on this particular concept only. And then there is certain businesses where you can say 70% of the transactions take place as a normal sale transaction, whereas up to 30% of transaction happens on this basis. So here, if it is termed as frequent transaction, it is not too many, it is not too less, somewhere in between. And these transactions are slightly lesser than the normal sale transaction. In that case, you will apply the concept what we learn in this method. Then lastly, you will come across businesses where the numerous transactions, majority of the transaction is the sale of goods or return approval basis transaction, and very few transaction as normal sale, right? So when the transactions are numerous in nature, how the accounts need to be prepared, how it will be presented, that is something we'll learn when we come to the C category. Am I clear? In the casual transaction, what happens, guys? There is 3 probability. Once when the goods are sent, right? Goods are sent, for example, this is the time period, okay? We have sent the goods on 15th of March. And we have given the opportunity to the customer to return the goods after 1 month. So please tell me, 1 month will expire on which day? 15th of April. So 15th of March, that is in 21-22 financial year, you have sent the goods. And 22-23, till 22-23, the time has been given for approval. So now what happens is, in between, there is 31st of March, which is year ending. So on 31st of March, you have to make certain adjustments for these kind of transactions. So there are 3 possibilities. Within 31st March, whatever the goods that you have sent, the customer will give its acceptance, approval. That is within 31st of March, that is in this period, the customer will give its acceptance. In that case, what will come? Okay, before that, on 15th of March, when the business sends the goods on sale or return basis, when the business is sending the goods, what entry will pass? Since business is sending the goods and you have to treat it as a normal sale, what entry will you pass? Trade receivable account debit to sales. You will treat this particular transaction as a normal sale. So the moment the goods are sent, when the goods are sent, what will happen? the sale has been recorded. Trade receivable, that is debtor account debit to sale. Now, after 15th of March, that is till the year end, in between that period, this 15 days is, let's suppose the goods are approved. Customer says, okay, I will accept the goods. In that case, what entry will you pass? No entry, because goods accepted, already the sale entry for that is recorded here now. So you will not per se record any entry when the goods are being approved or accepted by the customer, because the sale entry is already recorded. Second option is, within that 15 days period, that is between 15 March to 31st of March, the customer might upfront say that I don't want the goods, take it back. He's returning the goods. In that case, what happens? To that extent, you will reverse this transaction. So entry will be what? Sales return or sales account debit to trade receivable. I very clearly explained in the last class, why do we have sales return and why do we have a sales account? That has been clearly explained, right? Now, third option is that till 31st of March, guys, or as on 31st of March, we all know that the time granted for approval is not lapsed, because this customer has got time till 15th of April either to accept the goods or reject the goods. So on 31st of March, there is no confirmation of acceptance or rejection is coming from the customer. So what do we do as on that date? This sale entry we need to reverse, because actually the sale did not take place. Since the nature of transaction is casual, we did not want to have a separate headache for maintaining, accounting for the, the normal transaction and separate accounting for goods sent on approval transaction. For that purpose, we treat it as a casual sale. But both of us, we know that this is not a real sale, because the acceptance is not being given by the customer. Until the acceptance is not given, how can we treat it as sale? So on the year end, you have to reverse the sale entry. So what will be the entry? Sales account debit only will come. Sales return will not come. I specifically told you sales return in the sales return account, you can record the entry only if the customer is returning the goods. That is a specific purpose for the sales return account, which has been explained in the last class. So here, sales return account is not been used, only sales account debit. Sales account debit means reversal of my income to trade receivable. And this will be done at the selling price. This will be done at the selling price. This will also be done at the selling price. This will also be done at the selling price. Correct, no? We pass this entry, reversal of sale. In addition to this, we pass one more entry. What is that? Inventory entry to pass. Normally, the closing stock entry, what do we pass? Closing stock account debit to trading account. This is the normal entry that we learned in the financial statements. But here, I will not put closing stock account debit. Why? Because closing stock account debit means the inventory is with me. But here, the inventory is with the customer. I don't have it. So I have to differentiate. So for that, I'll create a separate ledger called as inventory with customer account debit to trading account. Here also closing stock account debit to trading account. Now, instead of closing stock, it is inventory with customer to trading account. This will be the entry. So till this we have learned. Any conceptual difficulty in understanding what we have done?
No, sir.
No, sir.
No, sir.
Now the question is, this inventory with customer to trading account will be recorded at cost price or market value, which is also called as NRV, net realizable value, whichever is less. This concept is coming from accounting standard 2, which talks about valuation of inventory. So when I take AS2 for you, you'll get a better clarity. As of now, you have to understand what is cost price. You know what is cost price? Cost price is all clear. Yeah. Market value is what? Selling price. Net realizable value. In the market, if I go and sell this product, what will I fetch? That is called as market value. Compare these both, whatever is less, that you need to record. So till this we have discussed in the last class, guys. Do you have any doubts in this? No doubts.
No, sir.
Wonderful. Acceptance can be given in 4 ways. One is oral acceptance. Second is written acceptance. Third is implied. Implied means you do certain actions or activity which will confirm that the sales has taken place. Right? So that is called as implied. And fourth is lapse of time. Now, till 15/4, if the opposite person, that is customer, does not accept it, neither reject it, he does not say anything. So at the end of 15th April, it is treated as accepted. So that is called as lapse of time. That is called as lapse of time. So if you remember, when we place the order in Flipkart, if you buy, let's suppose a shirt, he says that you have the option to return or exchange within 15 days. Within 15 days, if you don't return and exchange, we will treat it as a sale, and then you cannot even exchange and return. Same rule is followed here. Okay. So now, guys, let's come back to your study material. Sorry. Yeah, profit on cost, profit on sale. All of you clear with this? Profit on cost, profit on sale. We have discussed also in the last class. We did a recap of that, and we discussed this in detail in the consignment chapter as well. Right? Illustration 1 we completed. So we have to head towards illustration 2 today. Illustration 2 says that Amit runs an online store where the goods are casually sold on sale on approval basis. So guys, this is a question from which chapter? Sale on approval basis. So this is sale of goods on return on approval basis. And here the nature is casual, which is case number A. Amit runs an online store wherein the goods are casually sold on sale on approval basis. The following is the information provided to you during 2020. So guys, on 10th Feb, the sale on approval basis, that is 25% on cost is made. Guys, the word is sale on approval basis. So here, can I say the right word is goods sent? Goods sent. You cannot treat goods sent as goods sold because sales will happen only when the opposite person is giving acceptance. So here on 10th of February, goods are sent on approval basis. This is written in this way. So don't get confused. It is 25% on cost. It is 25% on cost. 25% on cost means what? Profit is 25% on cost. An amount is 1,20,000 and cost has been given. Correct? Next, on 20 February, goods returned by customer. Goods is returned by customer. Worth 80,000 rupees. In bracket, cost is not given. If cost is not given, then what is this? Sale value. 15th of March, goods on which approval was given by customer, 40,000. Goods for which approval was given by customer is 40,000 rupees. To the extent of 40,000 rupees sale value, the acceptance has been given. On 31st of March, goods with customer awaiting approval, 30,000 rupees. To the extent of 30,000 worth of goods, the approval is not yet come. All the above goods are sold ordinarily in the course of online businesses. This is another indication, guys. Had the word casual not been given, this word is another indication that this is casual nature of transaction. Please take a highlighter and highlight this point. Sometime in this same question, they'll give you examinations, but they'll not give you the word casual. Only they'll give you this line. If goods are sold ordinarily in the course of business, it means that it is a casual transaction where even the SOGRA related transactions are treated as a normal sale, casual sale. Considering that he closes his books on 31st of March. On 31st of March, books are being closed. You are required to pass entries in books of Amit to record the above transaction. Note, additionally, it has been provided that on 15th April 2020, that is the expiry date, the customer have rejected the goods for which approval has been pending on 31st of March. So on 15th of April, that is next year, they are saying that the goods is rejected. Is 15th April the last date? Nothing is mentioned. Okay, so 15th on April is just a random date. Next year, next financial year, that fellow is telling that I am rejecting the goods. Now, what are you supposed to do? So let's understand the question, guys, first. This is one financial year. This is another financial year. So we are into which financial year currently? It is 31st March 2020. Now. So we are in 1920. Yes. So we are into financial year 1920. And the next financial year is 2021. Now here, guys, on 10th of Feb, here that is 10 Feb, goods are sent. Goods are sent, not sold. Don't get carried away. On 10th of Feb, sale on approval means what? Goods is sent for approval. Now here, the goods is sent on 10th February at cost plus 25% profit. Right? So what is my sale price? Sale price is equal to cost price plus profit. Correct? Cost price is how much? 1,20,000 rupees. Profit, guys, profit is 25% on cost. So now this 25% is on cost and this 1,20,000 is also cost. Can I say both are related to each other? If I multiply both, can I get the profitability? Yes. So how do I get my profit? 1,20,000 is my cost price. 25% on the cost, that is 25 by 100 of the cost is my profit. So what is my profitability? 30,000 rupees. So what is my sale price? 1,50,000 rupees. Why did I find sale price? Because when goods are sent, you pass a normal sale entry. When I pass a sale entry, I need a sale value. That is why I calculated the sale value. Any problem in this? Any problem in this?
No, sir. No, sir.
No, sir.
Super. Next, on 20 Feb, guys, out of 150 worth of goods that has been sent, 80,000 worth of goods has been returned by customer. So here it is, 20 Feb, goods returned. Goods returned worth how much? 80,000. Goods returned worth 80,000. So guys, out of 1,50,000 rupees, guys, goods returned is worth 80,000. Okay. Then on 15th of March, to the extent of 40,000 rupees, the goods have been approved. On 15th of March, goods approved is 40,000 rupees. So 40,000 worth of goods has been approved. So out of 150, 80,000 is rejected. 40,000 is approved. How much is balance? 80,000 plus 40,000 is 120. 120 minus 150 is 30. 30,000 worth of goods. Neither the customer said yes, nor the customer said no. Which means till 31st of March, there is no clarity on this particular 30,000 worth of goods. Am I right or wrong? 80,000 is rejected, boss. 40,000 is approved. I have a clarity for these two items, but for 30,000 rupees, there is no clarity. So are you clear with this question? Yes. Are you clear?
Yes, sir.
The question says that
Yes,
15th of April 2020, that is the next financial year. Next financial year, 15th of April, the goods are rejected. Goods worth 30,000 is rejected. Now, what will be the accounting treatment here? Will there be any accounting treatment here? Is the question that they are asking. Are you clear with the requirement? Are you clear with the question, first of all?
yes, sir. Yes, sir.
Very good. Now, guys,
Yes, sir.
you're supposed to pass journal entries. What is the requirement? You're required to pass the entries in books of Amit to record the above transaction. Now look at the language, guys. They're telling that you're required to pass the entries in the books of Amit to record the above transaction, which means all the transaction is supposed to be captured. In some question, they will ask you to pass the adjustment entry on 31st alone. So you have to be very careful. In these kind of questions, it is not necessary that all entries you have to pass. What is asked, for that much only you have to pass. So here they're asking the entries for all the above transactions. So I'll come in the order, guys. The first transaction is taking place on 10th of February. So this is happening in books of Amit. So heading, guys, in the books of Amit. In the books of Amit. Journal entries. Can you write JE in the exam? No. You have to write full form. Date. Particulars. Please develop the habit of writing the format from now, because if you write in shortcut now, in exam you will not have the speed to complete it. The more and more you practice, the more and more speed you get. Right from now, have the habit of writing it neatly, writing it legibly. All the numbers should be clearly written. Don't write 6 as 0 or 0 like 6. So you have to be very, very careful. Then comes your LF column. Debit, rupees is important. Credit, rupees is important. Now, guys, date is important, 10th of February. So 10th February 2020. Goods is sent. Goods is sent. This is a casual transaction. In a casual transaction, when the goods is sent, you have to treat it as a normal sale. So what will be the journal entry? Very good. Sales account to trade receivable. Wonderful. Trade receivable account debit. Please do not go forward. Wait for me. Trade receivable account debit to sales. Being goods sent on approval. Being goods sent on approval. Now, guys, you can show the working here itself. Sale price is equal to cost price plus profit. Cost price is equal to 1,20,000 plus profit is 1,20,000 into 25 by 100. So which is 1,50,000. You can show the presentation below itself. Nothing wrong. You can also create a separate working note and do it. But that again, you write heading, give a cross reference. If you forget to give a cross reference, it could be a problem. So if it's 1 or 2 line of calculation, below itself we can show. If you're not feeling comfortable to show your separate working note also, you can show it. Not a problem. Whatever is faster and quicker for you, you can do it. So sale value is 1,50,000 rupees. 1,50,000 rupees. Any problem here, please? Any problem here?
No, sir.
Very good. Next, guys, we have to record the journal entries in the chronological order. So let's come in the order. So second entry is taking place on 20th of February. 20 February, goods returned by customer. So can I say it is a sales return? So what will be the journal entry? What will be the journal entry? Here 2 accounts affected. One is sales account is affected. In other words, sales return account is affected. Another is trade receivable account is affected. Sales return is credit balance. Being a credit balance, to increase my sales, I'll give a credit. To decrease my sales, I'll give a debit. So here my sales is increasing or decreasing? It is decreasing because it is a return. So decrease of sales return means debit sales return. So on 20 February 2020, sales return or sales account debit. Anyone you can write an exam. 2, trade receivable. Trade receivable is my debit balance. To increase my debtors balance, I'll debit it. To decrease, I will credit it. So do trade receivable. And value is 80,000. So 80,000, 80,000. Being goods returned by customer. No narration, no marks. Any problem here? Online people, any problem here?
No, sir.
No, sir.
No, sir.
Next, on 15th of March, goods for which approval was given by customer 40,000, which means customer has given approval to the extent of 40,000 worth of goods. For this, what entry will you pass? Approval for what it has been given? Approval or acceptance for sale is given. But the sale entry is already recorded now. So what entry will you record further? There is nothing to record. So on 15th of March, no entry. Not required, or you can put this and also write, give a reason that since the sale has already been recorded, on acceptance, you need not repeat the entry. Like that, you can show it if you want. So the opposite person will get a clarity that you know the concept. If you don't also should be fine. I don't think so this carries mark. What have you done in your textbook? I think this is only given for you to understand here. I don't think so they have done it for all the questions. So this is only for your knowledge and information. If you write, nothing wrong in exam. But I don't think so there is any mark allocation for this. But what is there to write? Just it will take hardly few seconds to write it now. Just put a note. No, it's okay. No. Next, guys. Next. On 31st of March, goods with customer is awaiting for approval, which means customer is neither accepted the goods nor rejected. So what will I do? Can I treat the balance 30,000 as a sale? I can treat sale only if the goods is being, the ownership is transferred. You'll be learning this concept in your higher grades that I can record my revenue only when the risk and the reward is transferred. Risk and reward of that particular product is transferred only along with the ownership being transferred. Here, when the goods are sent by the seller to the customer, the possession is being transferred. Seller might be holding the goods, but the ownership is still with the seller. Therefore, the person who is having the ownership of the goods, he is the person who will record it as a closing stock. So two things you have to take care of here. Since the ownership is not transferred, whatever sale entry you recorded earlier, to the extent of 30,000 rupees, you have to reverse it. Second, since the ownership is with the seller, he has to record the closing stock entry in his books of accounts. So two transactions will come here, guys. In this case, on 31st of March 2020, one is reversal. When I do reversal, you cannot write sales return. It will be sales account only. I've given the logic in the last class. So sales account debit to trade receivable. Trade receivable, 30,000 rupees. 30,000 rupees. Any problem here? Any problem here?
No, sir.
Next, on the same day on 31st of March 2020, we have to pass an adjustment entry for recording the closing stock. In normal business scenario, what is the entry for closing stock? Closing stock account debit to trading account. Here, closing stock I cannot debit because it is not our stock in our custody. I mean, the stock is not in our custody. Our stock is in the customer's custody. So therefore, I have to record inventory with customer account debit to trading account. Now this will be recorded at cost price or market value, whichever is less. What is the cost price that we have to calculate? What is the market value? 30,000. Because 30,000 is the net realizable value, which means if I go and sell this product in the market, I'm getting 30,000 rupees. That is the sale value. What is the cost price? Can you calculate the cost price? Not necessary. Not necessary. The question what Arjun is asking is, sir, obviously your market value and NR will be more than cost price. Cost price will be less now. There are certain goods over a period of time, their market value will be less than the cost price. Now, for example, no, I'll tell you. No, I'll give you example. I'll give you example. If you see this mobile phones, initially when it comes, it comes with heavy prices. For example, let's suppose I purchase I'm a mobile shopkeeper. I purchase let's suppose one mobile phone for 10,000 rupees. Okay. When the mobile is initially launched, it comes with a premium pricing. Let's suppose it goes with 16,000 rupees. So my profit here is how much? 6,000. Now let's suppose as days pass by, as months or years pass by, slowly when the new model is coming, this model becomes outdated. So eventually the market price will keep on reducing. From 16 it will become 15,000. From 16,000 it will become 15,000. From 15,000 it will become 14,000. Like that, keep on going. Sometime if there is some problem or inherent defect in the product, it can go to such an extent where you will be willing to sell even at 9,000 rupees. Because more than 9,000, nobody is willing to pay in the market. This particular model has got some deficiency, or this model has become outdated, completely outdated, no use. So what will I do? Having that particular piece in my stock, at least let me recover the cost. So even though there is a loss of 1,000 rupees, you are still willing to sell it because you will recover at least 9,000 rupees now. So there are certain business, where the products are in such a way, the price will go below the cost price. So it is not necessarily always the prices will be upper hand compared to the cost price. It can be even less. Am I clear? Okay. Now, how do I get my cost price? What is the formula to get cost price? Cost price is nothing but from sale price, if I minus profit, if I minus profit, I'll get my cost price. What is my sale value? 30,000 rupees. What is my profit? I need to calculate. Now, here in the question, they have given 25% profit on cost. So 25% is on cost. And this 30,000 rupees is sale value. So this is sale price. This is cost. Can I multiply both and get my profitability? Not possible. Not possible. So what do I need? I need to convert profit on cost. I need to convert 25% on cost to on sale. What is profit on sale? So if it is 25% on cost, what will be on sale? 20%. So if you remember, I gave you this chart also. If your profit is 25% on cost, on sale will always be 20%. So here, if this question comes in exam, will you waste your time sitting and doing a rough calculation to convert what will be on sale? No point wasting time. Immediately 25% on cost means 20% on sale. Otherwise, you have learned the technique how to calculate it. But for these kind of repeated questions, you don't have to sit and do the workings. Am I clear? So guys,
Yeah.
30,000 is selling price. If profit on cost is 25%, we saw that profit on sale always will be 20%. So profit on sale is 20%. 30,000 is sale price into 20 by 100. 30,000 is sale price. This is also percentage on sale. Both are related to each other. Therefore, I can multiply and get the profitability. So 30,000 is selling price. What is my profit?
6,000.
6,000. So what is my cost price? 24,000 is my cost price. So on 24,000 guys, if you calculate 25%, you'll get the profit on cost. On 30,000, if you calculate 20%, you'll get profit on sale. Both the profits will be same. What did I just say? On 24,000 rupees, you should apply 25%. The profit will be still 6,000 only. On 30,000 sale price, the percentage what you'll apply is 20%. Profit will be same 6,000. See, cost price is less. Cost, guys, listen to me. Cost price is less. When the price is less, percentage has to be more to achieve this. When the price is more, percentage has to be less to achieve the same profit. That's why I told you always profit percentage on cost will be higher compared to the profit percentage on sale. On cost percentage will be more, 25. On sale percentage will be less, 20%. If you see, the same rule is given. If it is 20% on cost, it is 16.67% on sale. So on cost is more, on sale is less. If it is 25% on cost, it is 20% on sale. Cost more, sale less. This is true only in case of percentage. In fraction, it will be opposite. In fraction, it is 1/5 on cost means 1/6 on sale. Just because 1/6 is given, 1/6 is not bigger. 1/6 means the percentage is smaller. When you divide 1 with 6 part, then you get lesser value. So 1/5 is more than 1/6. Don't get carried away that 1/6 is more or 1/5 is less. Are you clear with this part? Okay. Now coming back. So here guys, I'm recording inventory at cost price because cost price is 24,000, market value is 30,000, whichever is less. The less price is 24,000. So inventory you'll record at 24,000 rupees. Any problem here? No. Any problem here? No, sir. Guys, any problem here?
No, sir.
No, sir.
Now
No,
what
sir.
happens, guys? For the current financial year, all the entries recorded. If you see this entry when the goods is sent recorded, this entry when the goods rejected recorded, this 2 entries will come when the no approval, no rejection has been set. So this is the transaction up to the year end. Now they're telling that additionally it has been provided that additionally, if I tell you on 15th of April, the customer has rejected the goods for which the approval has been pending on 31st of March, what will you do? So on 15th April, next financial year, goods are rejected. What will you do? Will you pass any entry for that? Or will you not pass any entry? Here they're telling that on 15th April 2020, there is no need to pass the entry for the return of goods as they have been already reversed in 31st of March. 15th April, if you don't write any entry, I'm okay with it. But 31st of March 2021, boss, you need to pass one entry. Rather, I would say you have to pass an entry before that also. I'll tell you my logic, then you tell me if I'm right or wrong. I'll give you a logic. This is the trading and P&L account. This is the trading and P&L account for which financial year? Current financial year 1920. Guys, tell me one thing. I'm coming from the beginning, okay? Tell me one thing. Understand the concept. That is more important. Then what to do in the exam, we'll discuss. Guys, on 10th of February, goods is sent. Amit is sending the goods. For him to send the goods, he has to purchase from somewhere. Yes or no? Amit is sending goods to some random person, customer. So let's suppose Amit is the person who's listed his shop on the Flipkart platform. So Amit will buy from somewhere, no? Some from wholesaler or some from manufacturer. He'll buy now. So when he buys, he's buying the goods worth 120. So can I say in Amit's trading and P&L account, purchase will be 1,20,000 rupees. Yes or no? Yes or no? I'm discussing a normal final accounts question with all of you. The purchase account, that is a debit side of trading and P&L account, I will record 1,20,000 rupees. Do you have any problem? Tell me, online people.
No, sir.
No. So then what is happening on 10th of February? This 1,20,000 worth of goods is being sent. Since this is a normal sale transaction, we will treat it as a sale, and the sale value is 150. Yes or no? Everybody, yes or no?
Yes, sir.
Then what happens is on 20th of February, 80,000 worth of goods are returned. So minus sales return, 80,000 rupees. What is the balance sale? 70,000 rupees. Correct? This over, this over. Goods approved. So out of the 70, 40,000 is approved, which is actually the real sale. Yes or no? Yes, and 30,000 pending approval. Correct? On 31st of March, goods with customer awaiting approval has been passed as an adjustment entry. What adjustment entry we pass? Inventory with customer. What is the entry? Inventory with customer by trading account. Okay, wait, before that. I recorded this entry in my final accounts. 150, 150. Record here. Okay. Now here, I need to minus 30,000 now. Why? Because the goods is not accepted. 30,000 worth goods is pending approval. So what entry did you record here? Sales account debit to trade receivable. So sales you've debited now. So minus sales. So minus sale. So what? 40,000 rupees. 40,000 rupees is the actual sale. Do you get my point? Guys, you debited sale in two places. When the return happened, you debited the sale here once. When the goods were returned, you debited sale here. Debit sale means minus sales. And also you debited here to the extent of 30,000 rupees. You again subtracted sales, minus 30,000 rupees. So 40,000 rupees is your actual sale. Actual sale for which the acceptance has been received. Tell me yes or no. Yes. Everybody.
Yes, sir.
Any problem
Yes, sir.
understanding? Because if you don't understand till this point, you will not understand what I'm going to discuss next. Let's suppose all these are chocolates. These are 120 chocolates. 1,20,000 worth of chocolates. 1,20,000 chocolates. Each chocolate carrying 1 rupee cost price. And this, so here quantities, guys, 1,20,000 quantity of chocolates is being sold. Okay. Here, can I say quantity that is being sold is comparatively less? Here you recorded 100% expenditure. Here did you 100% sell all the chocolates? Whatever chocolates you purchased, 1,20,000 chocolates you purchased. Did you sell all the 1,20,000 chocolates? No. So here you've recorded the expenses for 100% chocolates. For all the chocolates that you purchased, you recorded the expenses. Here you recorded 40,000 net sales. Only let's suppose this is pertaining to how much percentage? Let's suppose this is 40% of the, out of 100% of chocolates, 40% only is sold. Recording 100% expense and recording 40% income. Is it right? We are violating which concept? We are violating matching principle. Matching principle says that you need to record the expenses. The quantity of expenses, how much you have sold. The quantity of expenses, how much you have sold here. That much quantity of expenses only you are supposed to record here. If you are recording 40% sale here, then your expenses should be also 40% only. Correct? If you don't do that, you'll be violating matching principle. This we have discussed in 11th standard trading and P&L account chapter. We also discussed in the 12th standard when we did NPO and partnership. We also discussed at that point of time. So what did we learn then? To reverse the purchases, to reduce my expense, I need to bring down my expense. Why? Because here you've recorded over expenditure. Let me give you a quantum. Now that's why I say quantity is important. Let's suppose one second, guys. So 1,20,000 chocolates is purchased for rupee 1. Now we have sold 1,20,000 chocolates into 1.25. So you'll get 150. Okay. So quantity purchase is 120. Quantity sent is 120. But eventually what happened? We had sales return. So few quantities kept on decreasing. So 40,000 divided by 1.25, which means 50,000 chocolates. 50,000 chocolates. $32,000 chocolates. No? How much it is? 32,000 chocolates into 1.25. It is 40,000. So finally, if you see, guys, after you had two reversal of sale, ultimately the chocolate worth 32,000 only is being sold. So if you look on the debit side, you have recorded expenditure for 1,20,000 chocolates. And you have recorded here sale for 32,000 chocolates. Is it comparable? So hence matching principle says that how much quantity of chocolates you have sold, that many quantity of chocolates only you have to record as your expense and purchase. This is the rule of matching principle. So now for that purpose, what do we do? You have two options. Either you minus the excess expenditure from this purchase to the extent of how much is the remaining chocolates. 120 minus 32 is how much? 88. To the extent of 88,000 chocolates, you reverse the expenditure purchase. If you minus this 88,000 from the purchase value, it is called as adjusted purchase method, which we studied in the 11th standard. This is one method. Another is, if you don't want to minus this 88,000 here, you can take this 88,000 to the other side. You can take this to the other side. When you take this minus to the other side, it becomes plus. So when you record this here, it becomes closing stock. So closing stock, what is the purpose of closing stock here? Closing stock is recorded on the credit side with the intention to reduce the over expenditure that is recorded on the debit side. In other words, the purpose of the closing stock on the credit side is to nullify the impact of excess expenditure that is recorded on debit side. So what did we do? We recorded closing stock how much? 80,000 worth of goods has been rejected. So 80,000, guys. 80,000 will be recorded as my closing stock. Am I right or no? 80,000 is the selling price, no? Whatever its proportionate cost price. 64,000 is the proportionate cost price. That is 80,000 minus 20%. Correct? Profit on sale is 20%. So 80,000 minus 20% if you do, you will get 64. So 64,000 is the closing stock. And inventory with customer is how much? 30,000 minus 20%, which is 24,000. This is nothing but the sale of goods that has been returned is 80,000. 80,000 is the sale value of goods which is returned. Minus 20% profit on sale if you do, you will get the cost price. Here it is 30,000 minus 20%, which is 64 plus 24, correct? 64 plus 24 is 88. So this 88, you minus it from the purchase. Profit on sale is 20% only, profit on sale. So this 88,000, if you minus from the purchase, that we call it as adjusted purchase method. If you don't minus it from the purchase, if you take it to the closing, if you take the closing stock on the other side, then it becomes positive 88. So the ultimate purpose of these two to be recorded in the financial statement, that is in trading account, is to reduce the over expenditure. Are you able to follow? Any doubts here, please? Any doubts here, please? If you're clear with this, I'll go forward.
No, sir.
All my students who have been learning from me from 11th and 12th, you should be clear. But others, those who have not watched my class yet, if you have any doubt in this, please ask me. Okay, now online peoples, Kavi, Abhi, are you clear? Chabi?
Yes, sir. Yes, sir. Yes, sir.
Okay, now guys, now tell me, this is the closing inventory with the customer. Can I say this will become the opening inventory? When this becomes the opening inventory, what should be the entry next year? That is, guys, please understand, when I record opening stock here, this opening stock worth, let's suppose that is the stock which is with us, that is our stock, 64,000, and inventory with customer 24,000. Okay, what is the nature of this? Is the nature asset or expenditure? When I record on the debit side of the trading and P&L account, this is the trading and P&L account of the next financial year, which is 2021. When you find opening stock on the debit side, the nature of the stock 64,000 and 24,000 is asset here or expenditure here? Think and answer. Everybody, others. What is the nature of the stock here? 64,000, 24,000. Is it expense or is it asset?
Expense.
Who's saying expense?
Chavi.
Okay, Chavi says expense. Others? Others? Chavi, any specific reason why you said it as expenditure?
Because we have credited here as expense in the previous year.
We have not created as expense. We have created as income in the previous year. Credit all income and gain. On credit side means it is income. To be very honest, this is not income. See, this is not income just because it is recorded on credit side. Credit all income and gain. Credit all income and gain. Recording closing stock and inventory with customer on the credit side is not income. Please understand, if I want to reduce expense, if I want to cancel a debit, I need to give a credit. If I want to reduce a debit, I need to give a credit. To reduce my expenses, another way is to increase the income. So here, the impact of recording the 64 and 24,000 is to nullify or to reduce the expense. So expense can be reduced by increasing the income. Are you able to follow? So here, it is not actually the recording of income. It is actually the reversal of expenditure. Now, here coming back, opening stock is treated as expenditure. You know why? The opening stock, that is our stock and inventory with customer, these both will be asset as long as the goods is lying down in the godown, whether it is in your godown or whether it's your customer's godown. As long as you own it, it is asset. The moment you sell it, it becomes your expenditure. So in the current year, that is 2021, the shopkeeper, when he sells the goods, will he sell from the opening stock, the stock what is available in the godown? From that, will he sell first or will he sell it from the new purchases? You will always try to finish off your old stocks now. That is the mentality. So which means whatever sales you're doing this year, first you're emptying from the opening stock. And matching principle says that these opening stock, which were the closing stock of last year, you were ineligible to be recorded as expenses because you were never sold. Guys, the 64 and 24,000 worth of goods were never sold. So they were ineligible to become as expenditure. Therefore, we removed them from the expenditure. Now, in the current year, the 64,000 and 24,000 worth of goods has been 64,000 and 24,000 worth of goods has been sold here. Now, matching principle says that now since you have been sold, now you are eligible to be treated yourself as an expenditure. So here in opening stock on debit side means that it is expenditure, which means the goods has been sold. That is why debit all expense and losses. So this opening stock will be treated as asset as long as the goods are lying in your godown. The moment the goods are being sold, the opening stock will be treated as your expenditure. So what is the journal entry for this? Trading account debit to our stock to inventory with customer. To inventory with customer. Right? So if the next year had the question told next year the goods are sold, then trading account debit to inventory with customer would have been my entry. But here goods are rejected. Next year the goods are rejected. Next year the goods are rejected. Now what will happen? This is whose P&L? This is Amit's P&L. This is Amit's P&L, guys. In Amit's P&L, inventory with customer is how much? 24,000 rupees. Inventory with customer is 24,000 rupees. Inventory with customer is 24,000 rupees. Can you treat this as expenditure? Can you treat this as expenditure next year? Because the question is very clearly told, the goods has been returned by the customer back to Amit. Next year, the goods has been returned. So can I treat this inventory with customer as expenditure? What am I supposed to do? Which means this entry is never passed, which means inventory, that is trading account debit to inventory with customer. Can I say this entry is never passed? And we cannot pass this entry because the goods is not being sold. So I cannot treat my inventory with customer as my expenditure. So in that case, what will happen, guys? Inventory with customer, can I say still is an asset? See, trading account debit to inventory with customer will come when 24,000 worth of goods is been accepted by the customer the next year. Then 24,000 expense will come here, 30,000 sale will come here. Therefore, the profit is 6,000 next year. But the question is very clearly told that next year, the goods have been rejected. When the goods have been rejected, which means the goods is not sold. When the goods is not sold, how can you record this 24,000 as expenditure? You cannot record it. No sale, no expenditure. So this entry will not come. But still we cannot forget that inventory with customer, you are debited. It is still lying in your books of accounts as your asset. How will you close this? Inventory with customer is still open. You have debited inventory with customer. So we open the inventory with customer ledger, to trading account karke 24,000 is coming. Carry down is 24,000 and brought down is 24,000. If brought down in the inventory with customer account is coming on debit side, means debit balance. Debit balance means asset, which means inventory with customer account is still open. Now, when the goods are rejected and returned, can you have this 24,000 under inventory with customer account? First, that goods is rejected, returned, it is coming back to me. It is now my, it's now my stock, as the stock is lying in my godown now. So what are you supposed to pass? At the year end, 31st of March 2021, that is the next financial year end. That is here on 31st March 21, you are supposed to reverse inventory with customer and have record closing stock 24,000, 24,000. This entry should come, but here they're telling that on 15/4 there is no entry to pass. Even I agree, but on 31st of March, at the end of the financial year, I have to pass an adjustment entry for the closing stock now. In 31st of March previous year 2020, that 24,000 was my inventory with customer. But on 31st March 21, this is inventory with me. Let's assume that the inventory is not sold. Only then this entry will come. Or to be more precise, I will not wait till 31st of March 21. If I am in your place, on 15th of April itself, I will pass this entry closing stock to inventory with customer. Because the goods have to be sold now. Only once goods come to my premises, only then I can sell it. I can send it to somebody else. So technically speaking, if you ask me, on 15th of April, I have to pass this entry. I cannot wait till the year end, because why will you wait till the year end? So you will increase your closing stock. Or else, if you don't want to do it, you can pass at the year end also. Even if you pass in year end, nothing wrong. What will happen? The goods have come to your godown on 15th of April and is gone out on 31st of March. Automatically, the stock coming and going out will tally, zero impact. Are you able to follow? So here they have told that 15th of April, no entry will come. There is no need to pass entry for the return of goods as they have already been reversed on 31st of March. But still here, one point they should have mentioned is that the inventory with customer account needs to be closed by transferring it to closing stock. That one point they have missed it out. And in no other question they have covered like this. So this is an extra information which I'm trying to give you. I'm trying to complete the loop. Here the loop is open. If I go with this pure question, I have a question to ask from all of you and even ICI. What will do with inventory with customer? Inventory with customer account, still ledger has got a balance. How do we close that? The loop has to be closed now. So I sense that this loop can be closed only by passing this entry. Closing stock is coming every day. It is only at the end of the year we tell how much is the closing stock. Normally, if you ask me, no, every month end, people take the closing stock and record the inventory. We don't prepare the financial statement only for the year end. There are some businesses who want the financial statement trading in P&L every month. So technically speaking, so let's suppose when I was working in the previous company, I was the finance manager. So I used to prepare the trading and P&L account for my MD for every month. We used to calculate closing stock every month and give it in the report. Are you getting my point? So technically speaking, I would say that this closing stock to inventory with customer, you have to record on 15th of April. At the max, 30th of April, you have to record it. In exam, what do we do? In exam, we'll follow what they are saying it here. Because if you write something else and something different, the suggested answer does not match, we cannot take that risk. So for exam purposes, we'll follow this. But conceptually, I'm trying to give you a clarity that how a loop should be closed. When you're preparing the journal entry, you need to vision, you need to focus on what will be the impact of the financial statement. To that level, if you're able to envision now, only then you can be in the process of making a good CA. You'll be in the process of being a good CA. Because all this kind of knowledge or envisionment you need to have when you practically go and do a work. Are you able to follow? Am I clear with this or not, guys? Please confirm. Am I clear or not clear?
Yes, sir.
Yes, sir.
Anybody's got any doubts here?
Clear, sir.
So
No, sir.
I targeted for 2 questions, illustration 2 and 3. I think we're done time up with illustration 2 itself. Right? So never mind, we can continue this in tomorrow's session. If you have any specific queries with regard to this question, guys, you can ask me. I'm having this forum open for next 2-3 minutes. If you have any specific queries, you can ask. Offline people, any queries? No, sir. Comfortable? The journal entries, what we recorded, you must be clear. And this understanding of the trading and P&L, are you clear? Are you clear with the understanding of the trading and P&L account? Yes, sir. Why closing stock is appearing? Because normally when I ask the question to a lot of people, why closing stock is coming both in trading and P&L account in balance sheet, people are not in position to answer. Now today, did you get a clarity on this? Yes, sir. Closing stock is recorded to nullify the impact of excess expenditure that is recorded. Closing stock is recorded to reduce the excess expenditure on the debit side. So online people, are you clear with this concept?
Yes, sir.
Yes, sir.
Yes, sir.
Wonderful. Other people? Super, super. So yes, that's all from mine for today's session, guys. I'll see you all in tomorrow's session from 11 a.m. to 1:30 p.m. So we'll have tomorrow's session for 2.5 hours, right? Until then, bye-bye. See you. Take care.
Thank you, sir.
Thank